Welcome to Talk the Walk. I'm Sarah Wong. Fighting continues to rage across Ukraine as Russia has ramped up aggression against its southern neighbor. More countries have joined the United States and the European Union to impose economic sanctions on Moscow. The measures are straining Russia's economy and currency while adding pressure to commodities markets and compounding supply chain disruptions caused by the pandemic. China has pledged its commitment to a friendship with Russia with no limits. But does it have the appetite to act while facing its own economic woes? Joining us today to break it all down is Michael McCarthy. He's the Chief Strategy Officer at Tiger Brokers Australia. He joined us from Sydney. Thank you very much, Michael, for being here.
Thanks for having me, Sarah.
Now let's look at the market. We've seen wild swings in oil prices in the past few days. What kind of pressure did the volatility create for the global energy market? And how soon can we see a return to relative stability, and under what circumstances?
Well, clearly the Ukraine dispute is the key driver of the latest volatility in oil prices, both upward and downward. But oil was already in a strong upward trend before this conflict broke out. Now, the reality is that Russia produces between 8 and 9% of global oil. It's an important contributor, and if all of that supply is sanctioned, it will have a long-lasting effect on the market. But of course, how long this conflict lasts and how long those sanctions last is a very open question at the moment. That's the reason why we're seeing such swings. In fact, on recent good news around the possibility of peace talks succeeding, we saw oil prices plummet from those highs around $140 a barrel to below $100 a barrel. So given the moves that we're seeing in that extreme volatility, and given the theory of volatility clustering, we're expecting to see further swings until the Ukraine situation is resolved.
Now, in its monthly report, OPEC predicted that Russia's war in Ukraine will severely hurt global growth and could weigh on oil demand. When it came to oil demand and oil crisis, I can't help but think of the Middle East oil crisis in 1973. Now, I wonder, 5 decades later, when OPEC, led by Saudi Arabia, proclaimed an oil embargo, what have the world learned and what are we still not seeing?
One of the reasons for the extreme highs in oil prices is the lack of investment in traditional energy assets over the last 15 years. With the whole world moving towards a carbon dioxide constrained universe, fossil fuels like coal and oil fell out of favour. Gas, of course, is included in that group as well. Now, with investors shunning that and moving towards renewable energy sources, there has not been enough investment in oil and gas infrastructure to feed the current demand with Russia offline. And I think this is what the Saudis are hinting at, that even though there are still extensive oil and gas reserves around the world, bringing them online is going to take time, and that the simplest resolution would be for Russia to come back into the global oil stable. That's not likely to happen, of course, while we still have that conflict. I do expect to see, first of all, the agile shale producers in the US jumping into action. We've already seen that with a lift in US onshore production, and other producers, particularly OPEC producers, could well be on the move. But I think one of the key takeaways from those comments is that it looks like, for now, the OPEC plus cartel that has dominated oil market supply for the last few years is busted.
Does that mean that is it fair to assume that our transition to green energy, climate commitment is still kind of incompatible with energy security?
And this is a key issue, and despite a lot of concern and a lot of desire for extensive renewable energy sources, the reality at the moment is the technology is just not capable of delivering the sort of power that is needed for sustainable power supply in developed nations. And until we get those breakthroughs in battery technology, in solar cell technology, and in particular in other forms of storage, we simply cannot rely on renewables for baseload power in developed economies. So with that gap, with that underinvestment in fossil fuel sources and that lack yet of the technology that will give us the scale that we need in renewable energy, we've got a big problem in the short term.
Now, following the crisis in Ukraine, different regions react swiftly. Now, let's first look at Europe. In a memo, you wrote that targeted sanctions could inflict real pain on Russia, but at a lower cost to Europe. The European Union, though, it moved to gradually slash gas imports from Russia, but stopped short of an outright ban. And that's, of course, because the bloc imported nearly 40% of its gas and more than a quarter of oil from Russia, with other oil producers, including Norway, admitting difficulty to fill that gap. Russia-EU trade was several times larger than Russia-US trade. Now, my question is, in the era of globalization, it seems that Europe is incapable of inflicting real or great pain on Russia due to its heavy reliance on Russian fossil fuels and their geographical proximity.
Well, of course, this cuts both ways. And while energy production makes up around 10% of the Russian economy, it makes up 50% of exports. And that's why it's so important to Russia and why the impact is likely to be harshest on Russia. But of course, Europe doesn't escape. And you rightly point out that that huge gas supply to Europe has left it in a vulnerable position. And of course, what we're talking about here is Germany. Germany has switched away from its previous power generation methodologies, and its dependence on Russia is a real concern for the outlook for the European economy.
Now, we know that since the late 1990s, when the financial storm devastated emerging markets, including Russia, Moscow has been beefing up national currency reserves, which blunted the damage during the crisis in 2008. And Russia said right now it lost access to half of its foreign reserves as a result of Western sanctions following its invasion of Ukraine. Can you give us like a holistic picture of the financial risks facing the Kremlin, even with all the self-strengthening measures it's taken since the late 1990s?
Well, the consequences of that risk are already being felt with the huge drop that we've seen in the value of the ruble to its lowest level since being floated. And that change in the value of Russia's currency has a profound impact already. It severely limits Russia's ability to import goods. It makes them much more expensive. And of course, with sanctions on the Russian exports, it's unable to take advantage of the relative cheapness of its goods. So that is already being felt in Russia. Once again, it comes down to how long this conflict lasts. And it does appear that one of the key issues here is Russia's desire to maintain a buffer against the NATO alliance. Ukraine has fulfilled that role for centuries. And so it's no surprise that strategically it remains very important. So if Russia and Ukraine can strike a deal whereby Ukraine retains its independence but fulfills that buffer role for Russia, we could have an outbreak of peace very quickly. And so I don't think at this stage we're going to see huge shifts in the global financial infrastructure, because analysts at this stage are optimistic about the potential for a quick resolution of the situation.
Russians are starting to feel the pinch of Western sanctions, but I wonder whether that pain will also be felt in countries which are imposing the sanctions. For example, Britain now moved to end trade relations with Russia and Belarus, and more Western companies are withdrawing from Russia, which threatened them with nationalization. And Moscow's financial apparatus has been evicted from the global capitalist system. I wonder, what does that spell for the future of globalization, and will the impact on Russia reverberate across the world because of the connectivity?
Well, the key question here is how long the conflict in Ukraine lasts and whether or not a peaceful resolution that suits both Russia and Ukraine can be reached. If it can, then the sanctions that we've seen imposed already and the stops that have been put in place in the financial system can be reversed quite easily. So it comes down to whether or not this situation can be resolved quickly and peacefully. And at the moment, analysts are leaning towards that. It makes sense for both sides to come to some sort of resolution. It does appear that from the 15-point plan that we've seen this week, that there are a few sticking points. The last one of them might be the fate of those people who are ethnically related to Russia but live in what is Ukraine territory. But other than that, it does look like there is potential for agreement between these two nations. And if that's the case, the impact on the global economy will only be temporary. If we are to assume, though, a worst case scenario and an ongoing ground war in Ukraine, it's definitely going to have a drag on global GDP. Not only will Russia be affected, but Germany's reliance on Russian energy means that there will be impacts across Europe. Of course, Germany being Europe's largest economy, any impacts there will echo across the continent. And with Europe still representing around 22% of the global economy, that's definitely going to have an impact on the globe if the conflict in the Ukraine continues.
Very quick, will sanctions still be popular if we're staring at a protracted conflict in Ukraine?
Yes. If Russia continues prosecuting a war in Ukraine, sanctions will remain in place around the globe.
All right, Michael, let's pick it up after the break. We'll be back in a moment. Stay with us.